When you see what has happened with interest rates over the past decade, you know how difficult this has been to see a market standing on nothing but air. Interest rates are not kept low to stimulate growth. They are kept low to keep the market alive. You came here for the truth, so let me unveil that for you. Today we're going to look at the situation with central banks, quantitative easing, interest rates, and so much more. The interest rate policies and the easy money policies of central banks are done in order to provide liquidity. Eventually, there are times in which we experience a drying up of the liquidity. In these instances, we have recessions or worse. Typically, what happens is that there are cycles within the financial realm where you will see increasing liquidity by a central bank, market goes up, equities, bonds, different asset classes. Now things are a little different because all assets have essentially been increasing in lockstep. They decrease in lockstep, and they are no different from one another in so many ways. We have experienced a time in which nothing really makes sense. Look around the world and you will see central banks all adjusting the interest rate policy for that particular country. This is the decision made by a select few that will determine so much of what happens in that country. The ECB's balance sheet is massive. You can see it's at around $4.5 trillion worth at this time. Clearly, they've been printing a lot of money over the past few years, trying to give hope to the market that we will be here to backstop any losses. Where's all this tapering that we've been told? Is this little blip along the way the taper that they were suggesting? There have been claims that they will taper off over the next few years, shrinking their balance sheet. I've heard that one before, but we'll see if it actually happens. Now, if the inflation pressures start to build, which generally is not a problem in Europe, but if we start to see interest rates trying to force their way up due to different reasons, central banks have a method which is very easy. Simply to bring those interest rates down, all they have to do is print money. They call it open market operations. Open market operations are a method that they've been using because of the fraudulent central banks and their policies. They can manipulate that, push them down. But what happens to the balance sheet as a result? Well, of course, it continues its trajectory to the moon. Market bets. Barclays predicts an increase in the deposit rate this year, despite Draghi saying at last week's press conference that he sees very few chances at all that rates could be raised in 2018. They're saying they will increase when you have the central bank saying we're not going to increase. That remains to be seen. But what I can suggest is that if rates increase, it is going to be detrimental to the economy of Europe. Maybe that will even push more money towards the US and other places. It all depends on what happens with interest rates. Ultimately, investors are looking for yield. And you look, even the Greek debt is not attaining what it once was, and it's better off to invest in US debt. And that's when things have really gone haywire. It also is important to look at the currency. What are the exchange rates at this time? There are other factors here. But just know, the market cannot be sustained any longer with very, very low interest rates. They need to go into the negative, which they have in many cases, or they need to basically decide this is the moment in time they're going to dry up liquidity, and as a result, they're going to bring the market down. They know that. And of course, they do this periodically in order to consolidate wealth and power. Many people don't realize that. They think that there's not a concerted effort here against us. Look at what the Fed has done. You can see this for yourself if you're interested. Just type into a search engine St. Louis Fed, and then you type in Fed funds rate. And you will get this exact chart here. And at this time, they're sitting at about 1.41. If we go to the most current data. But one thing I wanted to show was the last time around. This will give us a good idea of where it should have been. We saw irrational exuberance. We saw the housing bubble forming very clear. Anybody who was watching at the time. And there's this slow but surely increase. And you can see there was no stagnation. It seems like they were constantly lifting rates. And then they got to a point where they said, okay, we have some questionable things that are happening right here. Let's just hold off. Let's just hold off. And then they realize, oh no, we have a big problem. And so they dropped those interest rates down as fast as they possibly could. Then they went to the floor. There was no lower that they could take them. And it was there for years and years and years. And then they increased just a little bit. Just this very, very small fraction. Then they kept it at that rate for a long period of time yet again. Then they slowly raised again. Slowly raised again. And you know where this takes us. But the rate at which they're increasing is slower. The steps are further apart. And ultimately, what's going to happen by the time they need to decrease the rates? How far are they going to get? This is the 3% line. Based on what we're seeing here, it's going to take years and years and years just to get to 3%. The Federal Reserve is afraid. All central banks are afraid right now to increase rates. And last but not least, investment performance and world debt. When everything starts to go a little crazy. Now, I've noted before the year 2000. At that point there, things start getting haywire. But let's take this example. 1995. Just look at stocks. They're showing you the Dow Jones. And things have really gone out of the ordinary. Where things would move up previously, things will move up rather slowly, more gently. Crashes would be less severe. Recessions wouldn't be so intense. And now, when the stocks drop, it looks like a roller coaster on the way down. That's not good. You don't want to see that. One thing that we can tell over time is that this GDP number is not increasing anywhere near as fast as things like equities. It's a big problem. You have too much margin, there's too much debt, there's too much of basically everything except when it comes to the average person. Average hourly wage, the amount they spend on their groceries has gone astronomical compared to their actual income. The average person may not see it, but I've shown you here before, proved that the rate of inflation that the government provides, even the food inflation specifically, does not match up to actual food inflation. I've documented that here just recently. But of course, we can't rely on their statistics. All I can see here is there is a disparity in between the real economy and the stock market. That's what I try to outline in all my videos, and unfortunately, some individuals don't see that. They criticize. well, what can you do? But that's all for this video. If you found it informative, please give me a thumbs up. You definitely want to subscribe to this channel, so hit that subscribe button and join the nearly 85,000 people that are here at the Money GPS. If you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You could actually flip through these books. If you go over to Amazon, there's a look inside feature. It's going to allow you to flip through the pages of these books to see if you like them. Take care.